The question of the day is where will oil prices land going forward once the Iranian war is resolved to some degree, plus or minus where President Trump wants it to land? 41 years in the oil and gas industry, I've learned very carefully and over historical patterns, there's what we call a hard floor and a glass ceiling when it comes to commodity prices. The hard floor is that point in time in which it is counterproductive to be able to continue to drill wells, produce oil, refine product because there's just not enough profit margin in it. The hard floor is that basement price that has a very low elasticity. It's a hard stop that says at this point, we'll have to shut wells in, we'll stop transporting, we'll stop drilling new wells, we'll stop producing, we'll produce only what's available today that makes economic sense. But it's basically an industry stopping point that occurs because the value of the oil being produced is not worth the time, the effort, or the risk, and it's a negative cash flow proposal. Now, what's the glass ceiling? The glass ceiling is always there and always present, but it always changes in terms of how high that ceiling is. The glass ceiling is the commodity price, and the commodity price can and will rise according to supply and demand. But as demand shifts, as supply shifts, as they become counterproductive to one another, or they're in different time cycles to one another, then what you end up with is a glass ceiling that moves up and down, kind of like a floating lid in water. It goes up with the tide and down with the tide, but it's always present. Now, today, during the Iranian war, we have a situation where the glass ceiling is being tested. We're not trying to worry about the hard floor. The hard floor is fundamentally going to continue to rise over time when it comes to oil and gas. Why is that? Well, the very essence of drilling, producing, leasing, shooting seismic, all the things necessary to find oil and gas, that price, that basis continues to go up, has been. I started in 1985 with my career, and I've seen the price just continue to go up. And that break even, that point of inflection where the oil and gas price being paid doesn't justify any entrepreneurial effort. There's no reason financially to do any more than what you've done because it's counterintuitive to making a profit and making a successful venture work. So the hard floor in 41 years just keeps moving up. Back in 1985 when I started, price oil was running $9, $10, $11 a barrel for oil, minus transportation cost. We came out of the oil embargo. You'd think we'd be a lot higher price, but effectively the backside, which was the glass ceiling, had shattered. And that was consumers' willingness to continue to pay higher energy costs versus changing their lifestyle, changing the way they did business, changing their energy consumption levels. So that way the demand for oil fell, which caused the price to collapse. That's what happened in 1985. I just happened to join the industry at one of the low points when it came to commodity prices. Now, as demand came back and more consumers wanted that abundant, easily accessible fossil fuel, which is crude oil and natural gas, then all of a sudden the ceiling rose, which allowed the hard floor to rise. Because the hard floor rose as more competition came for services, equipment, raw material, drilling rigs, contractors, geologists. So more demand, higher prices, the hard floor or the base cost of a barrel of oil rose. By the time I got to the early 2000s, we were sitting around $27 to $35 a barrel compared to $11 a barrel in 1985. The glass ceiling, well, it had actually rose in 2008 to $145 a barrel because we were running out of oil in the United States, and Saudi Arabia decided to play with supply and give us a position that we were actually short of global supply of oil for a period of time that caused oil prices to almost triple, if not quadruple, over a period of 6 to 8 months. Why is the hard floor and the glass ceiling so important to you listening to this? Because it's polar opposite of what all the media is telling you. The Iranian war has a distinct functional value that is proposing today that really no one's talking about. And it's disguising, it's wrapping around the very elements of what runs the oil and gas industry globally. And that is the true numbers between the wellhead production and the final consumable barrel or byproduct from that barrel and all that process and economics in between. So with Iranians shutting down the Strait of Hormuz, with the United States claiming that we don't need it open, but we want it open, and all the vacillation over the last 90 days between We have a blockade. We don't have it open. We want it open. We have a deal. We don't have a deal. It all really has exposed the reality of the oil and gas industry globally, which is there is no greater energy source than fossil fuel in terms of abundance, accessibility, financial efficiency, transportability, logistics, and global access. There's oil all over the planet. It's just what you're willing to pay for it. Today, I believe that what has happened is the elements, what's behind the curtain has been exposed, which is if any particular terrorist group decides they want to financially cripple Western civilization or more modern economies and countries, all you have to do is stop or minimize the actual supply of their most valued precious commodity, which is fossil fuels, crude oil, natural gas, and natural gas liquids, and liquefied natural gas. It can cripple them financially within 60 to 90 days. That's better than any ballistic missile they can fire. Today, if you asked me, where are we at in terms of a hard floor, meaning what's the bottom base price specifically in the United States that we have to make just to economically break even or try to justify spending any more capital for producing oil and gas? Well, the majors might claim it's $45 or $50 a barrel when you look at which basin, what part of the country they're producing from. There's a lot of variables that go into that. But let's just say the base price in some of the majors like Exxon claim, well, $45 a barrel is our break even. Well, that's great. We're not Exxon. We don't own refineries. We don't sell at the gas pump. We don't have a full integration from the wellhead all the way down to the last molecule being consumed. The average exploration company only controls exploration, and they stop once it enters into the pipeline, the train, or the truck. So their break even is a lot higher because they don't have a beneficial value down the food chain as it's processed and refined. They're limited to only what they get paid by the very volume at the wellhead that is manufactured and produced from the wells that they own. I would say today the break-even price, including insurance and labor and risk cost and cost of capital and leasehold costs and mineral costs and tools and equipment and rising fuel for diesel and all the components that go into drilling a well, I would say you're getting closer to $60 to $65 a barrel for break-even. That totally dismantles the President of the United States' goal of we want to produce oil at $55 a barrel or less. Well, you're telling me you want me to go drill wells at a loss. You want me to put wells on at a loss. You want me to take my business model, tell my shareholders, my partners, my investors, we're going to go do all this expensive drilling and all this capital outlay so we can lose money. The answer is we're not, and we won't, and we haven't. So what has become the hard floor today, in my view, is probably $60 to $65 a barrel is the lowest price any oil company can justify drilling new wells or doing any kind of capital deployment until the price gets much higher than $65 a barrel. Now you might ask, well, who's drilling with the 452 drilling rigs today? Well, those are companies who are trying to replace declining curves. They're replacing lost reserves because we're producing 100 million barrels a day. And if they don't replace the wells that they have today because of their decline curve, their shareholders are going to see them as a diminishing value. If you're not making the same cash you did last quarter, your stock's going to go down. If you don't have as many reserves booked on the balance sheet as you did last quarter, your stock goes down. If you don't have as much cash flow and booked reserves, your bank's going to call your notes, your bonds are worth less money. There's a downside and a food chain effect from not being able to replace declining wells. So there's just a forced mandate. You will drill a certain number of wells, no matter what, at whatever price, simply to be economically viable and not unravel your financial scenario or your financial benefits from loans and shareholders and investors. Okay, absent that, your hard floor then becomes, well, really, what does it take for me to go add more rigs or drill more wells? Well, I need a margin of return, and I have to have a long enough runway that I can truly believe I'm going to get a certain value for the oil that I produce that allows me to make a profit, justify my capital, and build my balance sheet. Well, I don't think that anyone is going to actively go drill much more than the 452 drilling rigs that are active today in the United States if oil's not north of $75 to $85 a barrel. Now, because of the Iranian war, the one thing that the world has figured out is no other country's in a better position than we are. They either don't have the equipment, they don't have the manpower, they don't have the raw material, they don't have the budget, and they don't have the confidence that the runway going forward is somewhere between $55 a barrel and $155 a barrel. So for us as an industry looking at the hard floor, that floor has moved up from 1985 of about $11 a barrel. Today I'm going to tell you it's around $60 to $65 a barrel. Now, what does the glass ceiling look like? Well, the glass ceiling in today's Iranian war is really unlimited. Why is that? You say, well, how could it get to $150, $200 a barrel? Because if you can't run your country, if you can't provide utilities and electricity and jet fuel and transportation and diesel to run the tractors to farm the crops, you're looking at starvation. You're looking at lack of fundamental necessities like the staple goods, toilet paper and food and groceries and lights and internet. These countries who are financially better suited are going to raise that glass ceiling to make sure they have the fundamental necessity of fossil fuels in their market, in their ability to utilize it today, even if that ceiling goes up to $150 to $200 a barrel. Now, is that price sustainable? Is that glass ceiling sustainable? I would think not. If we have a hard floor at 65, and today, because of the concern of lack of supply, the ceiling raises to 125 or 150, the spread is too far. And if the spread is too far, one thing's going to give, one or the other. Either costs are going to go up because there's more demand for services like rigs and crews and geologists and seismic and drill bits and wellheads, and it's going to rise, and now maybe the base price becomes, hard floor becomes $75, $85 a barrel because it costs more. Well, that shrinks the spread between the price you're paying for oil and gas, the glass ceiling, and the hard floor. Or consumers decide, I can't afford that. I can't afford to take my motorhome out this summer. I can't afford 2 cars. I'm going to turn the air conditioner off and open the windows. I'm going to delay things that consume energy, which cost me a reduction in my usable capital as a consumer. So one or both things are going to happen either at the same time, or at least one or the other is going to happen simultaneously. That's going to squeeze the margin. The real question for all of us today is, with the Iranian war, with what the President of the United States is trying to do, where do we end up in 6, 12, 36 months from today? Do we find ourselves in a new hard floor range that's now $65 to $80 a barrel? Do we drop back to $55 to $65 a barrel? Where is the hard floor? On the flip side is, what is the ceiling? Now, what causes the ceiling to move is demand destruction. When you have too much value given to a unit of energy that people can't afford, they do one of two things. They stop using as much energy, or they find alternatives. What's alternatives? Coal, nuclear, hydrogen, wind, solar. The lack of price legitimacy, meaning the price is obtainable and absorbable by the consumer, causes them to either stop using it or they find some other source that is within the scope of their financial capability. That encourages and brings on energy competition. Now, if I look over historically 41 years, the reality of it is people always migrate to whatever's best for themselves. So if oil ceiling gets too high, consumers pull back, they use alternative energy. Eventually, the price of oil will come back to a point where the other alternatives are no longer economically. They'll fade away like they always do. And you get to a point so low that consumers forget the pain that they had. They'll forget about $120 oil and they'll be glad that oil is only at $90 a barrel. The hard floor has risen. That's the new sustainable hard floor. The ceiling will lift even higher than it ever has in the past, because now the pain threshold is somewhere between $85 and $90 a barrel, and as high as $125 or $150 a barrel over the next 20 or 30 years. This is true economics. It's supply and demand. It's vacillation between oversupply, lower demand, vice versa. And I can just tell you right now, the Iranian war and the uniqueness of what they discovered by the reaction of both United States and global leaders to a lack of supply of 10 to 15 million barrels a day has been probably the most stark weapon any military campaign has ever figured out. And that is, better than a ballistic missile, better than a nuclear bomb, is nuclear financial chaos as a result of cutting out 10 to 20% of all energy and doing it over 90 days. It has crippled the Western civilizations.